Are you unknowingly sabotaging your financial future? Every year, thousands of young investors lose money by making the same critical mistakes. But what if you could sidestep these pitfalls and fast-track your way to financial success? In this video, we're uncovering the top 5 investment blunders that could be costing you thousands, and more importantly, how you can avoid them. But here's the catch, these aren't just mistakes, they're opportunities to transform your investment strategy. In fact, what if I told you that avoiding these mistakes could actually be your greatest asset? Because the truth is, mastering these lessons could be the key to unlocking your financial potential. Let's dive in and turn these common errors into your stepping stones to success. Mistake 1, following the herd. Picture this, you're at a party and everyone is buzzing about the latest hot stock. The excitement is contagious, and you feel the pressure to jump in. But here's the catch. This herd mentality can lead to buying high and selling low, the exact opposite of what successful investors do. Many of you aren't old enough to remember this, but let's take the dot-com bubble of the late 1990s as an example. Investors piled into tech stocks, driving prices to unsustainable levels. Companies with little more than a website and a dream saw their valuations skyrocket. When the bubble burst, many were left with significant losses as stock prices plummeted and companies went bankrupt overnight. The lesson: successful investors do their own research and make decisions based on fundamentals, not hype. They dig into a company's financial health, its competitive position, and its growth prospects before investing. This means looking at earnings reports, understanding the industry landscape, and evaluating management's track record. Consider this. Warren Buffett, one of the most successful investors of all time, famously said, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian approach has helped him build immense wealth by buying undervalued stocks when others were selling in panic. Actionable tip: before jumping on the bandwagon, take a step back and ask yourself, is this investment aligned with my financial goals and risk tolerance? Conduct your own analysis and consider seeking advice from a financial advisor if needed. Remember, the goal is to build a portfolio that reflects your unique financial situation, not to chase the latest trend. Mistake 2, ignoring diversification. Diversification is a fundamental principle of investing, yet many investors fail to adequately diversify their portfolios. Putting too much of your portfolio into a single stock or sector can expose you to unnecessary risk. I implore you to read any of the books written by the greatest investor of all time, Warren Buffett. In any of those books, you will hear him repeatedly emphasize this point, which he believes is the most important thing any investor can do. Consider this. Investing heavily in tech stocks might seem smart during a boom, but a downturn can wipe out gains. Just look at the tech sector's volatility over the past few decades. During the dot-com bubble, many investors who were heavily invested in tech saw their portfolios decimated when the bubble burst. More recently, the rapid rise and fall of certain tech stocks have shown how quickly fortunes can change. Diversification doesn't just reduce risk, it can also enhance returns over the long term. By investing in a mix of assets, you can take advantage of different market cycles and opportunities. For instance, while stocks might be underperforming, bonds or real estate could be thriving, providing a steady stream of returns. Actionable tip: start by assessing your current portfolio. Are you overly concentrated in one sector or asset class? If so, consider reallocating your investments to achieve a more balanced mix. Look for opportunities in sectors or regions you might have overlooked. Remember, the goal is to build a resilient portfolio that can weather market volatility and deliver consistent returns over time. By embracing diversification, you not only protect your investments from unforeseen downturns, but also position yourself to capitalize on a broader range of opportunities. It's a strategy that has stood the test of time and remains a cornerstone of successful investing. Mistake 3, timing the market. Imagine trying to catch a falling knife. It's risky and often results in injury. The same goes for trying to time the market. Many investors believe they can predict market movements, but the reality is that market timing is incredibly difficult, even for professionals. Here's a compelling example. If you had invested $10,000 in the S&P 500 at the beginning of 2000 and stayed invested through 2020, your investment would have grown to over $41,000. However, if you miss just the 10 best days in the market during that period, your investment would only be worth about $18,000. Missing the best days can drastically reduce your returns. And those days often occur during periods of high volatility when many investors are tempted to sell. Actionable tip: develop a disciplined investment plan that aligns with your financial goals and risk tolerance. Consider using dollar cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This strategy helps you avoid the pitfalls of market timing and takes advantage of market fluctuations by buying more shares when prices are low and fewer when prices are high. Challenge me in the comments. What did I miss? Instead of trying to time the market, focus on a long-term investment strategy. By staying invested and maintaining a diversified portfolio, you can benefit from the market's long-term upward trend. Remember, it's time in the market, not timing the market, that leads to investment success. Mistake 4: investing in penny stocks. Penny stocks are like lottery tickets, enticing but risky. Their low prices and the allure of massive returns can be tempting, but these stocks often resemble low-quality, cheap products. Attractive but generally unreliable, penny stocks are typically associated with small companies that have limited financial resources and are often subject to extreme volatility. While some penny stocks have skyrocketed, finding the next big winner is extremely difficult. Many of these stocks experience dramatic declines in value, leading to significant losses for investors. Now, because I know half of you are going to label me as the fun police, I am not saying that you shouldn't invest in penny stocks at all, just that penny stocks should make up no more than 5% of your portfolio. Because I know you guys will venture into penny stocks, no matter what I say, just make sure your exposure is limited. Consider this: the story of a small tech company that seemed poised for success. Its stock was trading at just a few cents, and investors were lured by the promise of groundbreaking technology. But as time went on, the company struggled to deliver on its promises, and its stock price plummeted, leaving investors with significant losses. Now this is the part they don't tell you. While penny stocks can offer the potential for high returns, they also come with a high level of risk. The lack of liquidity and transparency in these markets can make it difficult to sell your shares when you need to, and the potential for fraud is higher. Mistake 5: emotional investing. Picture this: the market takes a nosedive and panic sets in. You feel the urge to sell everything and cut your losses. This is emotional investing at its worst, and it can lead to impulsive decisions that hurt your financial future. For example, during the 2008 financial crisis, many investors panicked and sold their stocks at the bottom of the market, locking in their losses. Those who let fear dictate their actions missed out on the subsequent recovery, where the market rebounded and reached new highs. Emotional investing often results in buying high and selling low, which is detrimental to your portfolio's performance. Consider this: the fear of missing out can also drive poor investment decisions. When a stock is skyrocketing, it's easy to get caught up in the excitement and buy in at inflated prices, only to watch the stock plummet shortly after. This cycle of fear and greed can wreak havoc on your investment strategy. Here's where it gets interesting. By sticking to a well-thought-out investment plan, you can avoid making decisions based on fear or greed. Develop a clear investment strategy that aligns with your financial goals and risk tolerance, and stick to it, even during market fluctuations. Remember, successful investing requires discipline and a long-term perspective. Actionable tip: create a written investment plan that outlines your goals, risk tolerance, and asset allocation. Review this plan regularly and use it as a guide during times of market volatility. Consider setting up automatic investments to remove the emotional component from your decision-making process. So, there you have it. 5 investment mistakes that could ruin your financial future. But by understanding these pitfalls and taking proactive steps to avoid them, you can set yourself on the path to financial success. I can confidently say that I have made all 5 of these mistakes myself. Drop in the comments how many of these mistakes you have made. Remember, investing is a long-term game. It requires patience, discipline, and a willingness to learn from mistakes. But with the right mindset and strategies, you can achieve your financial goals. If you found this analysis helpful, Make sure to subscribe to Wealth Window for more insights on building wealth and achieving financial freedom. And check out my video on the top investment strategies for beginners to start your journey today. Until next time, keep your window open because wealth isn't luck, it's strategy. Stay sharp, stay curious.